Well, great. Good afternoon, everyone, and welcome. Thank you for joining us for today's webinar, How to Optimize Offshore Jurisdictions for Your Fund Launch. Today, we'll be taking a closer look at the leading offshore fund jurisdictions, the BVIs, the Cayman Islands, and Jersey, and discussing how each compares from a legal, regulatory, operational, and practical standpoint. Whether you're launching your first offshore fund or evaluating options for future structures, our goal today is to provide practical insights to help you determine which jurisdiction may be the best fit for your strategy, your investors, and long-term objectives. My name is Anna Miller, and I'm the Strategic Growth Advisor here at Akram and Associates, and I'll be serving as your moderator today. So before we begin, I'd like to go through a few housekeeping items. For those of you that are attending for CPE credit, you'll need to remain connected for at least 50 minutes of today's session and respond to at least 3 of the 4 polling questions that will appear throughout today's discussion. If you have questions during the webinar, please submit them via the chat function here, and we will reserve time at the end to answer as many questions as time will allow. Following today's webinar, you'll each receive a copy of today's presentation. And if you do qualify for CPE credit, your certificate and associated details will be emailed to you individually. Then also note for this program, it's being offered at a basic level. There's no advanced preparation that was required and no prerequisites were required. With that, let's go ahead and begin and meet today's panelists. So we're fortunate to have an outstanding panel joining us today, representing each of these offshore jurisdictions, along with legal and operational considerations that go into selecting the structure that's right for you. So joining us today are Sam Rowe from Alston & Bird, Philip Parecki from Jersey Finance, Matt Mulry from Appleby, and Christopher Simpson from O'Neill Webster. I will have each of the panelists talk a little bit about their background and their respective firms, but I'll go ahead and briefly introduce Akram. So we are an assurance, tax, and advisory firm, and we're dedicated to serving alternative investment industry. Because we work exclusively with investment managers and their service providers, over the years, our team has developed deep expertise across the unique audit, tax, and operational challenges that arise throughout a fund's life cycle, all the way from launch through ongoing growth. Now I'd like to invite each of the panelists to speak about, to provide a little bit more details about themselves. So Sam, why don't you go ahead and get us started?
Sure. My name is Sam Rowe. I'm a partner in the investment funds group at Alston & Bird. We are a multinational law firm. We have about a dozen offices across the US and Europe. In our group, we represent every type of fund manager, including registered funds to private funds, 40 Act products to everything in between. So we're very broad in terms of our coverage, and I am very excited to be here with you guys.
Thank you, Sam. Christopher, or sorry, Matt. Matt's next. I see Christopher first on the panel. So.
Thanks, Anna. My name is Matt Mulry. I'm a partner with Appleby. I work in the Cayman office for the firm in the investment funds team. We set up a variety of Cayman structures, both in the master feeder context with US advisors and also as a standalone structures. We cover open-ended hedge funds, closed-ended private funds. Those funds cover a broad range of investment objectives, from private credit through to infrastructure, art funds, just a broad range. The managers that we work with are established managers as well as emerging managers who started their own startup, looking for a good funds jurisdiction to work with. Very happy to join the panel today, and thanks, Anna, for getting us involved.
Thank you, Matt. Next slide. All right, Philip.
Everyone, my name is Philip Parecki. I'm the America's lead for Jersey Finance, and Jersey Finance is the promotional body for the financial services industry in Jersey. Not New Jersey, but the bailiwick of Jersey, which is a crown dependency, one of the 3 crown dependencies. My responsibility is to promote the breadth of financial services that Jersey offers. So that's everything from investment banking to capital markets to funds, to fund administration, to family offices, to trusts and estates, to the full breadth of private client offerings. And there are roughly 15,000 people that work in Jersey's financial services industry. About a 35-minute flight from London. So just make a little point. Next time you're coming through the United Kingdom, make a point to come to Jersey. We'd love to host you. Thank you, Anna.
Thank you, Philip. And last but not least, Christopher.
Thanks, Anna. Good afternoon, everyone. I'm Christopher Simpson, corporate partner at O'Neill Webster in the British Virgin Islands. We're a leading firm in the BVI. We've been established for over 30 years, and we're a full service firm, so we cover all areas: corporate, banking, trust, litigation, and of course investment funds and regulatory. So we assist clients, with their BVI fund setup, investment manager setup, the entire process through to applications with the BVI Financial Services Commission and approval, and subsequent work post-launch. And so I'm delighted to be here this afternoon to share some insights about the various types of BVI funds and how you can incorporate them into your structuring.
Great, thank you, Christopher, and thanks everyone. Right, so brief overview. So, and all the panelists will talk about this in a little bit more detail as we get into the meat of the content. But at a high level, selecting the right jurisdiction is not just a legal decision, it's a strategic one. So the right structure depends on your investment strategy, your investor base, your fundraising objectives, operational needs, and your long-term growth plans. So throughout today's webinar, we'll compare the strengths and considerations of each jurisdiction and highlight some of the practical factors that managers should take into consideration as they evaluate making that decision. So with that, I'm going to turn this over to Sam to get us started. Oh, Sam, can't hear you.
Oh, sorry about that.
There you are. That's okay.
Anna, so many of you are either in the midst of planning a fund launch, or maybe you've done a fund launch before, but this is a very good overview in terms of all the work that goes into a fund launch. Number one, you obviously have to have a fund strategy, right? That's the sort of core investment thesis that you have when you're going out and approaching the market. And as Anna just mentioned, the next sort of step is choosing the jurisdiction and also legal structure, which I think goes hand in hand. But this isn't just a legal decision, but I think there is some strategic thinking and commercial thinking that has to go into it, because certain investments are better suited for certain jurisdictions, and certain investors are more familiar with certain jurisdictions. So marketing is a little bit easier. The conversation is a little bit more comfortable, right? So when you get to the stage of actually sitting down and thinking about the jurisdiction and the legal structure, the core thing that you have to think about is regulatory considerations, including the compliance burdens of a particular jurisdiction, because sometimes the cost can be a factor in your decision making. And another factor that you have to think about is the tax consideration. And by that, what I mean by that is not necessarily that you need to have the lowest effective rates, but each jurisdiction fits better with certain profiles of the investors and investments. So, talk to your tax advisor about the investments that you'll be making, the strategy, as well as sort of the investors that you're going to be expecting to market to. These are all considerations that need to be taken into account when you are choosing a jurisdiction as well as structuring your fund complex. By the way, the structure of the entities highly depend on the tax considerations as well as your commercial objectives. This can span from everything from your upper tier, meaning your management company, to the general partner entities, as well as the fund level, investment level entities. And sometimes you might have even blockers and SPVs for certain assets. So things to kind of consult with your legal counsel on, and also think about from a commercial perspective as well. After you've kind of set these structures in place, I think the next step people generally go through is finding right service providers, right? This is very critical. You know, you have to think about everyone from audit, tax advisory, compliance, consulting. You got to think about your legal counsel, accounting firms, administrators. Depending on your strategy, it might be like prime brokerage and also placement agent for marketing. And whenever you're looking for a partner in this space, you know, it's not a single lens that you look through. It's really about the fit. Depends on your strategy. Certain service providers might be better suited than others. And it's also a personality fit too. So you do have to kind of kick your tires and interview as many as possible and get good referrals when it comes to service providers. And once you have the service providers lined up, you know, the sort of the legal phase is like the fund documents. This is where legal counsel, whether that is offshore legal counsel or U.S. legal counsel, they'll take the pen and start drafting documents. And you know, as a fund manager, you're going to be intimately involved in every stage. But there's 3 core documents that go into this. It's the first one is sort of the governing document. If it's a partnership, you know, we call it the partnership agreement. This is where you lay out sort of the mechanics of a fund, how it would be run. You also put in governance rights for LPs. So that's the contract that holds everything together. You also have a disclosure document, often called offering memorandum or private placement memorandum. That basically outlines the terms of the fund. And in the US, it's not a contractual document, but it's more of a disclosure document. And it'll contain everything from risk factors to conflict of interest matters, and also introducing the investment program as well as a management team too. So it's a very handy sort of a booklet that investors will get to kind of learn about your product and also get all of the disclaimer language that go around fundraise. And sort of the step after that is just checking off all of the regulatory filings, make sure that that is all buttoned up. And then you're able to go into the capital raise phase. In this phase, you know, you might have investors that want to negotiate over the terms, so you do what's called a side letter. It's an arrangement that is outside of the partnership agreement or any governing document. Some investors will insist on having specific terms that are useful to them or that are required by law for them. So that process, again, is dictated by sort of the relationship between the manager and the investor, and you always have a legal counsel kind of on both ends negotiating that for you. And once you successfully are able to get the commitments or subscriptions, your fund is ready to launch. With that, I'll turn it over and get started on the BVI jurisdiction, which is covered by Chris. Oh, actually, before we get to that, sorry, let me go back to that. So I've already mentioned some of these factors that are required for evaluation, but again, to kind of reiterate, service provider selection is incredibly important because you go to the market with these service providers as your partner. So not only are they important to help you run the fund, fundraise, all of these things, they're also in your book as your service partners. So it's critical in marketing your fund, and investors will sometimes be able to evaluate sort of the fund's qualities by looking at the service providers listed. Structure selection, again, as I mentioned before, this is very much dictated by the combination of investments made and also investor considerations and costs. Again, depending on jurisdictions, this can vary quite a bit depending on how much reporting there is. Also, compliance matters. So this is something that you should definitely think about when you are making these decisions, and service provider partners will be able to help you with these. With that, I'll turn it over to Christopher on BVI.
Okay, thanks, Sam. All right, so the BVI is a leading fund jurisdiction, and we have various types of funds, and I'll sort of get into that a little later. The trend for 2026, we're seeing cryptocurrency, um, tokenized funds, and so on. But people come to BVI because there are various advantages that BVI offers. So we have a stable political and economic climate, which is committed to international compliance. We have a tax neutral environment. Our laws are based on English law supported by local legislation. There's no restriction on the investment policies of a fund, and other fee arrangements. So there's tremendous flexibility there. There's no requirement to appoint local directors or local functionaries. So that really allows you to sort of maximize where your service providers come from in terms of your fund. And in terms of fees, those are quite flexible, and are geared towards sort of emerging managers. Um, and there's no requirement for a local auditor sign off. So we have found that to be very useful for clients over the years. Next slide, please. Right. So in terms of the types of funds, and I'll just sort of run through them quite briefly. We have the professional fund, which is geared towards sophisticated investors investing at least 100,000 US dollars. And that fund was sort of the initial phase of the BVI sort of fund regime, and that proved to be quite popular with investors over the years. It requires functionaries, so you need to have your custodian, your auditor, and so on. Now we have sort of lighter touch funds. So, for example, now we have the incubator and approve fund, and those can be approved under a sort of lighter touch regime. Now, the incubator fund is primarily geared towards startup managers. There's a maximum of 20 investors, minimum investment of US $20,000, and maximum AUM of 20 million. So that's really geared toward sort of startup managers. No functionaries are required, so it's quite flexible. But it only lasts for 2 years. You can get an extension for another year, for a third year, or else you must then convert to a different type of fund. So the other type of fund that has proven to be quite popular is the approved fund, also under the sort of light touch regulatory regime. Also a maximum of 20 investors, an AUM cap of $100 million. So, that's quite a decent amount we have found for managers to use as their sort of platform launch. It has no minimum initial investment requirement, so that allows you tremendous flexibility. And the only functionary required is an administrator. So you don't necessarily need an auditor or custodian, and so on. And so we have seen that fund in particular grow quite well over the years. We also have the private fund, which is similar to the professional fund on a more sort of regulated regime. Maximum of 50 investors or investment on a private basis of up to about 200 investors. And so along with the professional fund, it requires all the sort of functionaries. And so now, as I said, we're seeing more of the sort of approved fund because of the lighter touch regulatory regime there. But obviously, if you want to go beyond 100 million AUM, then you're sort of looking at your professional fund or your private fund. We also have the private investment fund, which is not on there, but it is the closed-ended fund. And that sort of tracks the professional fund and the private fund. So there's also an option to have a closed-ended fund under sort of light touch regulatory regime called a private investment fund. Now, in terms of structure and strategies, there are various options. So we have segregated portfolio companies, which, as you know, has segregated portfolios and as governed by law. The assets and liabilities of each portfolio is separate from the other portfolios. And so that allows tremendous protection for investors. And we're seeing a lot more clients asking for segregated portfolio companies. And they can be used under any of the sort of funds we have there. So whether it's a professional fund or an approved fund, you can have a segregated portfolio structure. Master feeder structures, umbrella structures. We've seen a number of those, and those are quite efficient for sort of global investor access. Investors coming in from various jurisdictions with different entities feeding into, for example, a master fund based in the BVI. In terms of the investment manager, as I mentioned, you can have functionaries based outside of BVI for your fund. But if the BVI entity is a manager, managing the fund, then it needs to be regulated. And we have a manager that's called the approved manager, which has proven to be extremely successful. And it can manage BVI funds or foreign funds. So in the case of open-ended fund up to 400 million AUM and a closed-ended fund up to $1 billion. And we're seeing that being used to manage Cayman funds and funds in other jurisdictions. And it's not subject to economic substance. So the approved manager is really a good choice if you want to have a manager based out of BVI managing your fund. Now, in terms of, sort of jurisdiction peering, BVI works well with various jurisdictions, as I mentioned, Cayman, in terms of a BVI manager, for example, managing a Cayman fund. We're seeing quite a bit of those, and also the other jurisdictions, Delaware and so on. And in terms of service providers, we have lawyers, we have fund administrators, auditors, and all the functionaries based in the BVI. But you also have that flexibility where those functionaries can come from outside. So I think there's a tremendous offering in terms of what you're able to do in BVI from a fund structuring perspective. Next slide, please.
So we'll take a quick pause just to poll the audience with a question.
Okay.
So just take a few seconds to answer this. What is your biggest challenge? Is it cost, regulation, investor expectations, or launch timeline? We'll give everyone a few seconds here to answer. All right, looks like mostly regulation, right? Followed by investors and launch timeline. Okay, let's move on. Christopher, to your last slide.
Right. Yeah, so that poll was quite useful in terms of the sort of feedback there. In terms of costs, I think BVI offers a lower setup cost than some other jurisdictions, and so it's ideal for sort of startup managers and so on. In terms of formation, a BVI entity itself can be formed within just a day or two once all the due diligence information has been supplied to the registered agent based in the BVI. In terms of the approval of a fund, once that application is fully submitted to the BVI Financial Services Commission. That can be approved within as little as a week or 2 weeks. And we're seeing, a number of approvals coming in under that time frame. So once everything is in order, you can have your fund set up and approved within, a 2-week period. Flexible regulation, so it's business friendly, as I mentioned, and the regime itself, in terms of how companies are structured under the BVI Business Companies Act and the flexibility that it offers. And as I mentioned, no local auditor sign off. You may have directors and so on based outside of BVI. Tax neutrality, again, there's no capital gains, inheritance, or corporate taxes that would impact your fund and investors. In terms of confidentiality, information is not generally publicly available in respect of a BVI entity. The directors' names can be accessed at the BVI registry, but details on investors and so on are not publicly available. And in terms of any sort of fund structuring, things you must think about, BVI is often sometimes thought about as sort of a holding company jurisdiction, but it's much more than that. We have over 2,000 funds registered, and quite a number of investment managers also registered in the BVI. So it's not just a sort of holding company jurisdiction. You can come and have your fund set up and managed in the BVI, in a cost-effective and efficient manner. Yes, there are a number of tax treaties, and BVI has signed on to a number of them, similar to other jurisdictions. So, those are things that will factor in: CRS, FATCA, etc. Now, in terms of regulatory changes, I think offshore jurisdictions as a whole, we have seen changes over the last few years in particular, but we don't expect any sort of significant changes in the sort of near to medium term, but as the jurisdiction continues to evolve, I think it is sort of moving in the right direction, so now you have the sort of fintech era, tokenization and so on, and the BVI is committed to ensuring that clients can come to the BVI and set up their BVI fund structures. I think that's it. So over to Cayman.
Thank you, Christopher. Yes, please. Matt, tell us a little bit about the types of funds and the advantages of the Caymans.
Thanks, Anna. So Cayman has been a very popular funds jurisdiction for a number of years. We've put some statistics here, just setting out the number of funds that we've got registered in Cayman as at the first quarter in 2026. So we're approaching 31,000 funds in Cayman. There's an even split or slightly favored split for private funds. Hedge funds were originally the staple for funds set up in Cayman, but I think following sort of 2008, we started to see a lot more private funds being registered in Cayman. I think there was a convergence of investment managers who would do both open-ended and closed-ended funds, hedge funds and private funds, whereas I think historically there was a split between managers doing that. We now see managers getting involved on launching both those types of funds. Private funds, I think, have really grown on the back of private credit investment, where private funds are acquiring loans, debt from institutions, from companies, and making available to their investors the benefit of those private debt investments. And the private fund has really been the vehicle of choice for a lot of those private credit funds. Commonly, the limited partnership structure. Cayman funds are largely used by US managers. About 60% of our business comes from US managers. We also see managers coming out of the UK and Europe, and probably representing about 20% of the funds we launch. And then we get a lot of funds come through from Asian managers, again, probably representing the balance of 20% there. We have a sort of description here of the mutual funds and the private funds that we see in Cayman. Mutual funds are our open-ended fund structure. It's our sort of original fund vehicle. Those funds break down into registered funds, limited investor funds, administered and licensed funds. Those are broadly our four regulatory categories of open-ended funds. Now, open-ended from the Cayman perspective means that investors are able to require a redemption from the fund, require their funds to be returned to them on an ongoing basis during the life of the fund. Conversely, for a private fund, a closed-ended fund, investors are not able to require the return of their investment. They need to wait till either the manager is winding up the fund or potentially as illiquid investments are realized, their funds will be returned to them. It will always be at the option of the fund. Going back to the mutual funds, the registered fund is our most popular fund in Cayman. It's a fund that requires a minimum investment, initial investment from investors at $100,000. And that fund requires an administrator to be appointed. That administrator can be anywhere in the world. That administrator will usually cover the subscription process, keeping the register of investors, cover AML requirements for the fund, cover FATCA and CRS reporting, and also beneficial ownership register requirements. That fund represents at least 90% of the funds that we have registered in Cayman for mutual funds. Limited investor funds tended to be a small initial fund. In Cayman, if you have no more than 15 investors and you give those investors the power to appoint and remove directors, you'll come within that limited investor category. The distinction between registered funds and limited investor funds is now very minimal. Really comes down to whether you want to have that minimum initial investment requirement in your fund and the number of investors that you have. An administered fund in Cayman also doesn't require that minimum investment level, but it does require you to appoint a locally licensed administrator in Cayman. Licensed mutual funds are our retail fund categories, very few of them in Cayman. Cayman's really only used for sophisticated investors, and it's not really a retail fund market. In Cayman, most of our funds are registered with CIMA. There's very few exemptions. Currently, it really just comes down to single investor funds that aren't required to be registered with CIMA. The CIMA registration application doesn't involve any regulatory review by CIMA. It requires submission of an application offering documents, consent letters from the admin and auditor, and a fee. The turnaround time from CIMA is usually around 1 to 2 weeks for issue of a certificate of registration. That's the same for both private or mutual funds. On the private fund side, there's no need to appoint an administrator, but you do need to appoint a local auditor. Both our categories of regulated funds need a local auditor. There are some additional requirements for private funds in connection with valuation, safekeeping of assets, cash monitoring, and security verification. The private fund really has evolved or has proven itself to be a very popular, very flexible regulated fund type within Cayman, and I think the figures reflect that. I don't think there's been any additional headaches in connection with the launch of a private fund that our manager clients have found in comparison to the mutual funds. They are separate regulatory regimes, but they are very light touch. I would say that maybe one of the key differences between the private funds and the mutual fund is that you do have an initial period with private funds where you can go out to market. So we'll see in this slide here, we mentioned that you need to register within 21 days of accepting commitments, but you have got that period within which you can market the fund and do initial marketing of the fund and consider whether you do have enough investment to justify a registration. We could move on to our next slide. I think we look at some of the benefits of Cayman. So yeah, the advantages of launching in the Cayman Islands. The reputation that Cayman has really is the key driver, I think, for many who are looking at launching an offshore Cayman fund, whether it's part of a master feeder structure and you're also launching a US fund, or whether it's a standalone fund. Many of your target investors will have heard of Cayman, will be comfortable with Cayman as a jurisdiction, and will have pre-prepared due diligence questionnaires that they will be able to provide to you that accommodate the Cayman fund type. So it's very well known. It's already a marketing badge to be using a Cayman fund. Cayman is a British overseas territory with English common law roots, very similar to the other offshore jurisdictions. And I think that that British rule of law is something that is highly valued from investors, from other commercial counterparties. It's an international standard and has a lot of good reputation behind it. The tax neutrality, I think, again, very similar for all the offshore jurisdictions. We don't have any local taxes, which makes Cayman, as well as the BVI and Jersey, a great conduit for investor funds. For any offshore fund, we can take in assets from investors. We can then distribute those assets to investors with no local tax impacting their returns. It's only the tax that is levied in the jurisdiction of the investment and in the jurisdiction of the investor that's relevant. In terms of regulation, we are in Cayman. We are a jurisdiction that does embrace regulation, particularly on the anti-money laundering side, and does embrace international cooperation with incentives and initiatives that are pursued by the US, by Europe. So we do have a very robust AML regime in Cayman. We do comply with international tax reporting to over 100 jurisdictions. And we do have a transparency regime in Cayman that meets international standards. Professional services in Cayman are at a high level. We have a lot of lawyers working in Cayman who have come from onshore jurisdictions. We regularly work with international firms who keep us on our toes. We have all of the largest names in accounting based in Cayman available to cover the Cayman audit. The quality of administration in Cayman is very high. Any service provider using in Cayman will be aware of the commercial pressures that you're facing and will work with you to get things done within your timelines and to the standards that you need. We can do same-day incorporations, very efficient regulatory approvals. As I say, no comments from the regulator on the fund documents, and a turnaround time of around a week for certificates of registration, all of which makes Cayman a very attractive jurisdiction. We don't regulate investment objectives, so we don't have any particular investment objective models that you need to work for. We don't impose any investment restrictions on any types of investment objectives. So we're very flexible on the investment side. Our offering documents are similar to what Sam said at the outset, are disclosure based. It's not a document that is affected by our regulation. It's really about getting the right disclosures within that document. So we're very flexible, allow a lot of flexibility in you as managers crafting a fund and the fund constitution and offering documents in the way that you need and the way that your investors want to see. So yeah, we're a very flexible jurisdiction, very popular, very efficient. There's a lot of good things about Cayman, and very much welcome you to use us or other lawyers within Cayman. The jurisdiction is very much open for emerging manager business and funds business. Maybe we could move on to the polling question.
Great, thank you, Matt.
Thank you.
Yes, please. Yes, I'll turn it back to the audience again for the next polling question. Thank you, Matt, so much. So if you are in the process of launching a fund, what jurisdiction are you currently considering? Caymans, BVIs, or Jersey? take a few moments here to get your answers in. Three more seconds. If you haven't put your answer in, please do so. All right. Thank you so much. So higher indexing on the Cayman side. Matt, probably because you just finished speaking so eloquently.
Thank you.
All right, with that, I will turn it over to Philip, which is so Jersey is a jurisdiction I think people are less familiar with, right? So we really would love to hear more from you on just the details behind the types of funds that tend to select Jersey as a jurisdiction and maybe some of the advantages to picking Jersey.
Thank you, Anna. Actually, I'll start by going back to that poll that you just did. I think that actually is a pretty good reflection of the funds industry globally and how much of that sits at the center in Cayman, in particular in the US context. Quite a lot of our structures in Jersey have links to Cayman, which is part of this broader British diaspora. So all of us on the panel today are representing, Sam's obviously US based, but the rest of us are representing a broader sort of nexus of British territories, and Cayman BVI is overseas territories, Jersey Crown dependencies or Crown dependency. But what I'd like to say perhaps is that all of these jurisdictions can solve the structuring needs in different ways that managers have. They have advantages and they have disadvantages. Now, of course, I realize on this panel, I'm the only non-lawyer. So giving any type of advice is probably criminally negligent. So I'll just make sure that I'm not giving any advice here. I would highlight, again, specifically that all of these jurisdictions can solve the problems that you have. And then the question comes down to why and what works better for you. We have on the slide here some of the structures that Jersey has. If I had to highlight one in particular to look at, it would be the Jersey Private Fund, which can have, as of last year, it can have an unlimited number of investors. You can get that approved within 24 hours as long as you have a Jersey DSP, which is a designated service provider. But there's an expert fund regime, listed funds, and cell partnership structures. Again, this will all be driven by the advice that you get from counsel. And I think the key to take away here of these structures is that it will come down to the specific fact patterns of what it is that you are trying to accomplish. And if I could go to the next slide, please. So the regulatory framework, it's going to be similar in many ways to what Matt and Christopher have discussed previously. I think we're in all of these jurisdictions are well regulated with a robust regulator that takes their job seriously. And the reflection of that is in the institutional, I think the reflection of that is in the institutional partners that we have in our jurisdictions. I'll speak from Jersey's perspective. We have actually now undertaken a competitiveness review. It started well over a year ago. The results were made public earlier in this year. And the consequences of that are a root and branch revisiting of Jersey's financial services laws with the implication, or the desired outcome is to be the 21st century solution for global capital flows. I'm looking at this list here. It says that we have our COBA consent, which goes back to 1958. So when you have years and years of financial services laws stacked on older laws, there is a time that comes where you have to reevaluate these things. And there was an amendment to order the repeal of COBA I think that was in April of this year. So my point I'm making is that the jurisdiction, I'll speak for, again, just for Jersey, is recognizing the competitive landscape of the world and trying to solve broadly our clients' needs. Anna, if you could go to the next slide, please. So this, I think, comes down to the managers that are listening to this and the lawyers listening to this. This is like why. Like, so why would you, what is the evaluation matrix that you use when you look at these different jurisdictions? Again, speaking from Jersey's position, we're centrally located, meaning we're centrally located globally. So why that matters, because if you have any operational sensitivity on a daily basis, you're going to need a jurisdiction that can cover, and you're global in nature, you need a jurisdiction that can cover every time zone. When we look at where our largest growth has happened, and I'm speaking just from the US because I represent the US market for Jersey Finance, it's in that framework. It's where there is operational failure risk and the ability to have a full day of coverage. That's been one of the key areas for us. This has been particularly important in a lot of the downstream structuring on the closed-ended side of the fund universe. I'll touch on a couple of other things going right across here. Actually, I mentioned that you can have your fund launch within 24 hours. Matt highlighted this earlier, which is we're tax neutral, similar to Cayman and BVI. But I suppose where the distinctions probably get made here, one, I mentioned the fact that we're geographically in the middle of the day. The other bit is access to the European market. So there are, typically when I talk to US managers who are looking to raise capital in Europe, when you really push on what in Europe means, it's usually the United Kingdom or Switzerland, which is actually outside of the EU. And so those are very different approaches. But if you're actually looking to raise capital in the continent, then you start getting into being able to access those markets via private placement. When we look at it from Jersey's perspective, if you take, say, for example, the Netherlands, there are, you would, in order to get access to the Netherlands, you would need to not be in a tax uncooperative jurisdiction. Jersey is one of those jurisdictions. They're in the approved third country list for the Netherlands. Why do I mention the Netherlands? I mention the Netherlands because if you are actually raising capital in Europe, that is going to be the #1 jurisdiction for you to raise capital in. It's the largest jurisdiction that provides capital to, provides private placement capital. So you'd need actually you'd need to be based in a jurisdiction where you can raise capital in the Netherlands. I mentioned we are Crown dependency. I can't speak for BVI, but I think both Cayman and Jersey are AA- rated. So that gives you some indication on the stability, the fiscal stability of the country. It's politically stable. We have, I mentioned 15,000 people that work in financial services in Jersey. It covers everything, as I mentioned at the beginning, from investment banking to funds to fund administration to corporate services to trusts and estates. Jersey has the oldest trust laws in the world, family offices, multifamily offices. So you have a breadth of services, and with 15,000 people working in the industry, depth of talent. So I suppose the next bit on this list is substance, and this is, I heard this mentioned earlier, all the jurisdictions have exceptional professional services. I think what's made Jersey unique in this case is the number of investment managers that actually operate in Jersey. And I'll just make a point on why that's important. So we have about 240 investment managers, some of which are household names that operate in Jersey. And I don't mean are structured in Jersey, I mean are operating in Jersey. So that is portfolio management done in Jersey. That's trading and execution done in Jersey. That's portfolio analysis. You have portfolio managers, you have analysts in Jersey. Trading and execution, I mentioned. Well, how can you do that from Jersey? Well, we have the second fastest broadband speeds in the world. So in some ways, Jersey has become, and I'm using a London reference, a mini Mayfair. And the consequences of that have been profoundly positive, because when you have essentially a small London or a small New York sitting in the island, all of the professional services around them have to elevate. So we've seen a significant amount of onshore lawyers flying in to service their clients, primes flying in to service their clients. That elevates the entire ecosystem. And looking at from my perspective, over the last several years of, Anna, to your point when we started, trying to bring awareness to Jersey, it's that's probably made the biggest difference, because where we're talking to people, they've actually been to the jurisdiction to see their actual clients. So I think this has made it's made a significant difference in the quality of the service on the island. I'll leave it, I suppose, with this, that I mentioned right at the beginning, sorry, that we do a lot with Cayman and BVI. So part of this broader British diaspora is that you can solve your problems in many jurisdictions, and oftentimes you need to create a vehicle that solves a particular problem, and that can get plugged into your Cayman structure, as an example.
Great, thank you so much, Philip. I'm going to turn it back over to the audience again really quickly for our third question. So which factors would you consider most while considering a jurisdiction for your specific fund launch? Again, cost, easy to launch, so ease of launch, or institutional framework. Seconds. Framework looks like it ultimately finished in the lead. All right. So now that we've had our experts in the respective jurisdictions present and take a deep dive, appreciate your time. Sam, can you maybe kind of take a step back again and now think about, positioning? What are some of the critical factors, and really how the various jurisdictions stack up against each other?
Sure. I think these pages kind of summarize nicely what's been covered in this presentation. Without going into each one, I think, we learned that certain jurisdictions are better for emerging managers, and certain jurisdictions may have more institutional name and recognizability and friendliness. Some jurisdictions provide access to certain geographies. So I think there's sort of differing qualities about each jurisdiction that can really be beneficial for the particular type of investments that you're trying to invest in, as well as the sort of fund that you're trying to run, as well as your investor base. So I think it's not an easy decision, but working with your service providers and people that are advising you, I think you can make a very informed decision about which jurisdiction would fit you best. And so hopefully, you're able to take these slides and kind of compare side by side when you're making these decisions. And obviously, all of us are available for any conversations that you might want after this. So please feel free to reach out. Should we go to the next slide? Or was that it?
There were two slides on the comparison, but to your point, I think we're kind of at the tail end of today's discussion. But yes, this is the last slide before we go into any Q&A that might have come through. perhaps, so maybe we could have each of the panelists just from, again, kind of high level, talk about your respective jurisdiction and what it is ideal for as a quick summary takeaway. We can start with Christopher here for BVI.
Thank you, Anna. Yes, so BVI is quite flexible. I think it is quite suitable for emerging managers with our approved and our incubator fund. So if your budget is a bit smaller, BVI can definitely provide something for you. And it's really growing in the space, in the digital asset space. So we're seeing a lot of funds that are exploring that area, and being set up in the BVI. Also, the approved manager, which has been quite popular in the BVI, used to manage BVI funds and also foreign funds in other jurisdictions. So yeah, BVI certainly offers, something that any manager, large or small, can work with a fund structure in BVI.
Thank you, Christopher. Matt, for Cayman?
I think, yeah, Cayman funds. I think we just remain the jurisdiction that's most well known for Cayman funds. I don't think there's a particular type of fund that we particularly accommodate. We have a large amount of expertise here in all sort of fund types. I think the crypto funds is something that is growing in Cayman. It's still a small part of, I think, what we do. I think it's a small part of what many managers do, but it's something we can accommodate. We introduced tokenized fund amendments to our Mutual Fund and Private Funds Act this year. So we do regulate tokenized funds in a slightly different way. I'm just focusing in on the tokenized element, the smart contract element of tokenization, and the tracking of tokenized funds. It's something we're seeing more of, and I think it's a great area to keep an eye on and to see how that develops. I think there's a lot of potential for tokenization of all asset classes, but particularly of investment fund equity interests, and that's something that we're keeping an eye on and we're wanting to promote within Cayman. We certainly do accommodate large hedge funds and institutional capital raisers, big ticket structures, hedge fund investors and global allocators. But I think Cayman is also still relevant for emerging managers. It's a jurisdiction that you can start off in Cayman. You could also start off in BVI and grow in BVI or other funds jurisdictions. But I think it's important to still consider Cayman, despite being perhaps a higher cost base on an initial launch. Once you've got your fund going, I think Cayman does still make sense for all fund structures. So yeah, I think Cayman is a very attractive jurisdiction and a good product for all involved.
Great. Thank you, Matt. And then Philip, in 1 minute or less if possible, just that why Jersey? Key reasons.
I think that similar to the other jurisdictions, you can establish in Jersey as at a emerging manager level. It's going to be very similar in price to Cayman, and so it would be that I think would be the right comparison to make. But what's not listed in what Jersey's ideal for, and I just want to touch on it because it's been mentioned a few times. So Jersey's taken a real strong approach to tokenized assets, and actually, as of 2024, March of 24, Jersey launched its first sort of tokenization platform. It went through an entire reimagining of its laws around this, and that goes back to 2014 when the world's first Bitcoin fund was actually launched in Jersey, and the ICO guidance was initially issued in 2018. So digital assets forms a important strategic element within Jersey. I'm not sure where I landed on the minutes, but I also know why you gave me a warning.
Yeah, we're right at the top of the hour, so we'll have this. Okay, let me ask this last question real quick. So what type of fund are you launching? Hedge fund, private equity, venture capital, digital asset, or family office? You can go ahead and just keep answering that. We'll leave it open for a few more seconds. But with that, I know we're at the top of the hour. We did have one question that came up regarding just the benefits of onshore versus offshore. Perhaps I can recommend, since we are out of time, that we can send some additional information. Maybe when we send the deck out to everyone following this webinar, we can provide some of those details. So thank you for submitting that question. And I think with that, I just want to thank all the panelists here for joining today and all of you for participating in today's webinar. Hopefully you walked away with some good information and a framework that you can use to help you really evaluate what's the best jurisdiction fit for you. So with that, just hope you have a great rest of your afternoon, and we look forward to seeing you next time. Thank you.
Bye.